Welcome to another episode of the Wealth Alchemist podcast. And today we are going to be talking about markets.
I don't know how many of you are watching Bloomberg or keeping an eye on the S&P or watching your favorite variety of news, but if you pay any attention at all to the markets, you might have noticed that we are now at higher valuations in the S&P than we were in 2008.
And today is September 9th, 2025, for reference.
Yeah, that's a good reference. Thank you for that. And what does that mean? Quite candidly, it means that the S&P average overall is trading at very high multiples. So if we take a stock trading at $10 a share and they have $1 of earnings, they're trading at a PE of 10, one times their share price. So if right now we're trading at high double-digit PEs, whereas typically the S&P might be range-bound between, let's say, 13 and 17. Right now it's very high, and all that means is there is more risk. Whenever you have high PE ratios across the market breadth, you have more risk. All that to say, there's better opportunities for big downturns, because if things don't go well, the markets will reward you, us, with a downturn, because people will get skeptical and they'll pull their money out of equities, and that'll bring stocks down. The key point that I want to make is your advisor should be the voice you're listening to. If you trust your advisor, if you've been with your advisor for some time and they're doing a great job, there are so many voices out there. I've seen headlines, everything from stocks will never recover, which has been written on the headlines multiple times in my career. You better get in the stock market now or you're going to lose out, which has been headlines multiple times in my career. Gold is the new norm, multiple times in my career. All of those bits and pieces mean zero to you unless it's coming from somebody who knows your circumstances, your net worth, your income needs, your portfolio goals. Listen to your advisor. And frankly, if you don't trust your advisor, fire them. If you're feeling like you need to go hear from other people instead of your advisor, you're with the wrong advisor.
Let's back all of this up because we're talking about potential growth or recession in the markets.
Right.
A good advisor is also not just going to look at short-term market performance or economic performance. And what they really should be doing is relating this performance to an overall financial plan.
Sure. And some advisors operate the way we do, where we have different pools of money for different goals. So if I've got a goal that's 15 years down the road, I can afford to stay in growth stocks and equities, let them fall and recover, and 15 years from now, statistically, the markets are going to be higher. But if I have to pay off a loan in 2 years, or I'm going to retire in 2 years, or I need to make a capital purchase of any kind, I better have a bucket or a pool of funds that are set aside for that specific goal. Similarly, if I'm taking income from my portfolio, I'm hoping that your advisor has you in things like dividends and interest-bearing securities. So even if the values go up and down, I talk about milk and meat cows, they're still kicking off the milk so that you can continue to live your lifestyle no matter what the markets do.
And a good financial plan, you're already going to have all of these market fluctuations considered in a plan.
Always. Your financial plan should be in writing. Your advisor should be able to show you on a document how you're going to be okay.
And that could be a digital document.
It could be a digital document or a login. We work with e-money in our office. So your accounts are there, your withdrawal needs are there, your future purchases are there, and they're being tested against things called Monte Carlo scenarios or some other testing modality that says, hey, based on what the markets have done in the past and maybe even some scenarios we haven't seen, I'm going to be okay. And that's the key, because when your advisor is making a decision for you, when you say, I want to get out of the market, your advisor is looking at, well, do I believe that what you own is going to fall more than the taxes you're going to pay to sell today? If I want to do a Roth conversion, Does it make more sense to do it now while I'm working and earning six figures? Or does it make more sense to do Roth conversions when I'm retired? So your advisor is looking at all of those levers and your plan and making those decisions. The one thing I will tell you, and I just can't stand on this rock high enough, the media, the internet, social media,
news channels
are not your friend. Their job is to wind you up, create drama, keep you watching because things are scary and you don't want to miss this.
That's how they get their ratings.
Call your advisor where you can have that confidence.
I want to go back to something that you said that was very interesting to me. Is you said we have the opportunity for, or may be rewarded with, a downturn in the market. What do you mean by opportunity and reward?
So when the markets go down, we get to see, I think it was Warren Buffett who said, when the tide goes out, you see who's got their pants on. And he was talking about markets, right? So when the markets drop, you get to see.
That's quite the visual.
You get to see how the company is really behaving, what their balance sheet looks like, et cetera. We're leaning models towards what's called value. So low priced, high dividend paying stocks, not the high priced. Certainly there's room for some of that, but right now we think that value's got a little more appeal because those are stocks that are trading at normal values and still have dividends paying in addition. If the markets pull back, we may become very bullish on growth stocks.
Right.
So we may see opportunities to go ahead and move some assets into maybe small cap growth, maybe international growth, maybe the tech stocks. So we see those bear markets. We always say the bears bring the honey.
We have the bear print in our hallway.
We do, with the bees buzzing around.
Because bears bring honey. We can't just have bull markets all the time.
We can't. And unfortunately, we've been trained. I mean, it's been several very good years. And COVID even surprised everyone. I think we're seeing some of that start to finally end, which could or could not lead to a recession. We saw the jobs report last week, and it was mediocre to dismal, depending on your perspective. I don't put a lot of emphasis on short-term reports. I look at the longer-term reports.
You talk about a lot of the market activity and economic factors. You call them clap on, clap off tariffs.
Right.
So with that in mind.
That is not a political statement. It's simply
No.
that they come on and they come off, and they come on and they come off.
What do you see from your experience over the last 27 years in the business? What do you see in the future? I know we don't have crystal balls, but.
I think the future is bright for the United States. I think the future is bright for our local economies in the long run. Peter Zeihan, I don't know if folks are familiar with him, Zeihan. He's a global strategist and talks about the accidental superpower when the United States became the financial king of the hill post-World War II, when we promised to protect everyone and keep their shipping lines open as long as they were part of our group, which is the North American Trade Agreement. We're pulling away from that right now. And again, I have to say Peter predicted that. He said eventually the Western Hemisphere, we're going to be our own manufacturing. There'll basically be an East and a West instead of China making everything and delivering it to the West. We'll start to manufacture our goods back in the Western Hemisphere. It could be Central America, Colombia, South America. It could be the United States, which we are seeing manufacturing increase. But basically, we'll go to an East-West economy. There's only two nations that have a growing population of the developed countries, and it's France and the United States.
And even both of those are not growing as quickly.
Not growing as quickly as they were, and quite candidly, immigration issues might change some of those demographics. But the other side of that is we are the largest consumer. We get beat on all the time for being the largest consumer and the biggest violator of the environment. Well, if we're buying our own goods instead of importing those goods, that stands very promising for the United States. I just saw where the tariffs were dropped again by Canada on 85% of goods. This is a moving target, but here's what I do know. I do know that as long as the world continues to evolve, that we continue to consume goods, companies are my best bet. Companies are out there to make money. And when you invest in good quality companies with good morals and ethics, typically they're going to make money over time. And the government's job is to spend money. So folks that want to invest in things related to the government, I'm a little less likely to want to join in on that party. I think bonds look very attractive right now. I think as interest rates likely come down, that's going to push valuations up. And higher quality bonds, I think municipals currently offer some good opportunity. These are not forward-looking statements per se. There's always risk. I would always talk to your advisor about what you should specifically be investing in.
There's
but
always,
in the long run, equities win.
Yeah, there's always some type of something going on in the economy, whether geopolitically, politically, globally, domestic. There's always something going on. If you go back and you look through all of the headlines for all of the years, there's always something going on where something is going to plunge or soar.
Yeah.
And so it's really to keep that temperate outlook on the long term rather than what's going on right now.
You know what I've always said? I wouldn't get on an elevator that said plunge and soar.
Who would?
And I challenge you to listen to any of the financial stations. In 3 or 4 days, you'll hear them say plunge or soar. And it will be a couple 100 points or 100 points, and it plunged or soared. It didn't ease up or ease down or slightly move.
Right.
It was momentous. You know, that whole saying, the windshield is more important than the rearview mirror. I beg you to show me a chart on equities where it went down and stayed down.
Yeah.
It doesn't. It always moves up. Small caps, mid caps, large caps, domestic and international, over time, they all move up. And so you've got to keep your eye on the long view. Could that come to an end? Yes. I wouldn't want to see what that looks like. I don't think any of us do. And if it does, the last thing I think we'll be worried about is our portfolio. And for right now, I don't think that's an issue. So keep your eye on the ball.
Okay. So wrapping up, top 3.
Number 1, trust your advisor. If you have a trusted advisor. If you do not, find one you do. Talk to your friends, talk to your family. Find an advisor you can trust. Number 2, have a plan. Make sure that plan is in writing. And number 3, look for great questions. And I always say I can judge the caliber of someone's intelligence by the questions that they ask. So look for great questions to ask your advisor, and look for your advisor to ask you great questions. Big open-ended questions where they're learning and understanding you, and where you can make sure that you understand who, what, where, when, and why your portfolio is doing what it's doing.
I love the plan part. Keep your eye on the prize. And it's so easy to get distracted in a world of information where it's counterintuitive to what your advisor is telling you to do and where your plan is going, because you don't want to course correct and end up going in a different direction.
No, there's so many plans that can work, and your advisor's built one for you. And a lot of times the things that you might force them to change actually hurt the plan in the long run.
Okay. Well, thank you for joining us for another episode of the Wealth Alchemist podcast, and we'll see you next time. Bye-bye.